The third in this series of webinars, where what we're focusing on is the impacts on portfolio construction when you move away from the traditional 60-40 approach to portfolios. On Tuesday, we looked at the impact of having an objective built around retirement incomes. Yesterday, we spoke about ESG, or responsible investing, as an objective for clients. And today, we're going to be talking about the impact on portfolios when an important part of portfolio construction is dedicated to thematics or alternatives or new economy investments. Daniel Stojanovski, the Chief Investment Officer of Ventura Funds Management, will be moderating today's session, as he has through this whole series. Before I hand over to Daniel to introduce our three panelists today, let me just tell you briefly about some of the upcoming events that we have. Managed Account Awards, for those of you who are participating or contemplating participating, entries should be submitted by the 23rd of May. I know we've already started to receive those, but I'd encourage you not to leave it to the last minute, but get your registrations for entries in now. And then in July, we'll be hosting our live Advice in Action conferences in Melbourne and Sydney, where we'll focus on the issues around running efficient advice practices, the things that make advice practices more effective and more targeted at the particular segment they aim to serve. Now, for today, of course, we encourage you to ask questions, and you'll find a Q&A button at the bottom of your screen. So now it's my pleasure to hand over to Daniel Stojanovski, who will take us away on issues around portfolio management in the new economy. Thanks, Daniel.
Thank you so much, Toby, and welcome everyone to the third session today that we're running. And as Toby sort of mentioned, there are, we obviously started off with looking at, okay, well, how we creating portfolios outside the conventional and the setting objectives outside of the conventional 60-40 accumulation frameworks. We've looked at retirement, we've looked at ESG and responsible investing, and now this third session is just focused on a little bit more on the new economy, thematics, alternatives. How is that approached in a portfolio setting? And I think it's quite a topical sort of area for us all, as well as for clients. Now, I'll just introduce everyone before I sort of continue on with just a little rundown of the session. I'm joined with Hugh Lam, the investment specialist strategist at Betashares, Chad Hitzeman, who's the Hitzeman, who's the head of institutional sales at Global X, and Michael McCorry, the chief investment officer at BlackRock. Now, if I'm looking at this session and introducing it, and looking at obviously the role of alternatives and thematics or less liquid investments in portfolios, the way we've always approached it in Ventura, and for those who don't know me, I'm the Chief Investment Officer at Ventura, Daniel Stojanovski. We obviously run a number of SMAs and managed accounts, as well as being the main asset consultant for Centrepoint Alliance and their dealer groups. Now, the way it's approached from advisor settings, portfolio construction, how we've approached it is really alternatives in that sense are really used as an asset class for two main reasons. The first is to generate returns that are different to that of equity and bonds. Obviously, when equities and bonds are in challenging economic cycles. And then the second is to broadly diversify the portfolio and the portfolio construction process, harvesting returns that are slightly outside of the normal risk-adjusted returns that we receive from equities and bonds. And obviously trying to, at the same time, create portfolios that are lowering correlation, and we all know that correlations are a free kick in portfolios, and also trying to lower the volatility and looking at how the volatility metrics are done across the board. Now, again, you can create portfolios without alternatives, but given what they do and their complexities, it does add some high quality investments that can be used for clients. And these asset classes are meant to deliver the same type of risk and return characteristics, but just lower the overall volatility and correlation in portfolios. So that's sort of how we approach it. And obviously on the thematic side, it's interesting depending on the type of portfolio you have, depending on the type of portfolio you're trying to aim for from an objective perspective. And let's say it's a low cost or not so low cost, and you need thematics around that. That's where some of those thematics can really play and provide a bit of an edge from a portfolio construction sort of perspective. So, continuing on from that, I might sort of introduce and get Hugh, our first speaker, up to sort of give a brief overview of his presentation.
Thanks very much, Daniel. So yeah, my name's Hugh Lam. I'm an investment strategist at Betashares. I might just first start off with, definition of alternative and thematic exposures. As we know, there really are investment exposures that sit outside the traditional definition of, your equities and bonds. So think of things like, your long short funds, short bias funds, commodities, real estate, infrastructure. These have really sat within that alternatives bucket. And with thematics, these can provide structural growth drivers to subsets of the new economy. So there are things like, AI and data center ETFs out there. Cybersecurity is another big one as well, uranium and defense. Naturally, these have become, more and more popular as investors seek exposures beyond just a traditional 60/40 portfolio. So, Daniel's mentioned this, slightly earlier, but the real sort of role these exposures play within portfolios can really be boiled down to a couple of things. One is on reducing risk within a more diversified portfolio. So typically, you'll tend to find alternative and thematic ETFs having lower correlations than your traditional equities and bonds. So when you do add that to a 60/40 portfolio, you can reduce that overall level of portfolio volatility. Now, the second sort of role that these exposures can provide is capital growth. So if you do have a very strong investment thematic, such as cybersecurity, that can generate quite consistent returns. So when you combine both risk mitigation or volatility reduction, in addition to that capital growth component, you can really enhance risk-adjusted returns. So we've got this slide here, which really illustrates from a numbers perspective how an addition of a 5% gold allocation would look like to something like a 60/40 portfolio. So what we've done here, this is really utilizing the building blocks that we have at Betashares. You can see that on the left-hand side, we've got a 40% allocation to Aussie fixed income. The other 60%, we've just done a naive 50/50 split between Aussie and global shares. Now, what I've done in this sort of example here is that I've just dialed down the 40% Aussie fixed income exposure to 35% to free up more money to gold. So we have a 5% allocation to gold. Now, this simulation was done over a 10-year period ending 30 of April. And you can see to the table on the right-hand side, you're getting an increase in, your average returns, but you can also reduce or maintain a similar level of volatility. So the end result is that you can enhance your risk-adjusted returns as measured by the Sharpe ratio here. And that's sort of the roles of alternative and thematic ETFs play within a broader portfolio, as I mentioned a bit earlier. Now, it is important to note that, thematic and alternative ETFs won't, necessarily displace a whole portfolio. As you can see here, I've done a 5% allocation, and that's something that we would generally advocate for. Thematic alternative ETFs should generally have a satellite allocation. It will really depend on what sort of exposure you want, but it could be anywhere from 5 to 10%. When you are considering adding something like gold or commodities, infrastructure, or thematic ETF, it's quite important to do your homework, see what the level of correlation looks like to your traditional or core equity bond exposure, and see sort of what risks are you bringing into that portfolio. Does adding something like private equity make sense if you've got a substantial equity exposure within your portfolio? And also, if within bonds, you carry duration risk as well. So if you're adding something like an alternative bond proxy, again, does that make sense from a risk factor based perspective? And so, overall, we generally find that a robust investment strategy consists of having a broad market cap beta as the core, and then really utilizing thematic and alternative exposures as a satellite to help enhance those risk-adjusted returns. I know there's a bit of mention of illiquid investments and private markets. It is, they have risen in popularity, both private equity and private credit ETFs, promising high returns. There are a few structural issues with that, namely the mismatch between liquidity of the ETF wrapper and the underlying assets. It's something that, our philosophy isn't really based on, but if we were to launch something within the private market space, we would really have to ensure that the liquidity of that vehicle, being the ETF wrapper, aligns with the liquidity of the underlying investment. So something like, an interval fund structure might make a bit more sense, providing investors, frequent redemption gates that they can rely on, whether that's quarterly or semi-annually. But yeah, so just to recap sort of my presentation here, it's important to understand what thematic or alternative exposure you are adding to your portfolio. They're not all the same, but really just focusing on what does that correlation look like to your 60/40 core, and also what risk might you be bringing into that portfolio. I think that's something that's really important for all asset allocators and investors to consider. Thanks very much.
Thank you so much, Hugh, for that one. And what I might sort of get now is just to have Chad from Global X just take us through his presentation.
Sounds wonderful, Daniel. I'm always in the habit of starting quickly and diving right in, so let's dive right in. Very delighted to be here. I'm Chad Hitzeman from Global X ETFs. As quick biographical background and a little bit of scene setting, Global X, we're an asset management firm specializing in listed liquid exchange-traded funds. We're multi-asset in our offering. We have roughly 40 exchange-traded funds populated on Australian exchanges. Our focus has been diverse in the type of ETF strategies that we run. So as a quick sample, we have ETFs that are focused on equity income, say through buy rate strategies. We have ETFs that are more thematically oriented, and we'll dive a little bit deeper into what that means for us. We have ETFs that focus on liquid alternatives. And Hugh mentioned a few there, such as commodities, precious metals, and increasingly even digital assets. All the while, also, we have more traditional portfolio building blocks for plain vanilla exposure. So on slide 3, today in a speed round overview, we'll canvas Global X's best idea for constructing portfolios in something of an alternative manner. So number 1, with thematic equity ETFs for risk profiles predominantly that are high growth and growth, so accumulator portfolios. And number 2, by adding non-correlation. And to our mind's eye, that's a fundamental characteristic of alternatives, non-correlation, and adding that into a portfolio mix by using liquid diversifier ETFs, principally such as gold. Slide 4, getting started. Number 1, thematic ETFs. The thematic opportunity set over which we run several exchange-traded funds is pictured here on the diagram. And diving into the adoption curve runway, emergent thematics are at the lower end of the adoption curve, such as hydrogen, more nascent industries that have yet to prove commercial viability, and more mature defensive growth thematics are positioned at the top end of the S-curve, such as social media. And as you move along that adoption curve runway, it means the thematic has growing addressable markets. And a simplified definition for thematic ETFs, they have a specificity of focus on certain equity areas, and they enable investors to step away from broader universes like the ASX 200, the MSCI World, the S&P 500, in order to pinpoint areas possibly tailwinded by growing addressable markets. And very topical today is cybersecurity, artificial intelligence, and a few other thematic categories. So the why of why invest in thematic ETFs is because market portfolios such as the MSCI World can underrepresent companies connected to unfolding structural change. Think, for example, energy transformation and transition in nuclear energy companies. And because thematic ETFs, number two, amplify the degree to which a portfolio, growth or high growth risk profile ones, attempt to be alpha seeking and assuming active share risk. And you're doing this by using a diversified ETF rather than single stocks. Slide 5. I wanted to show that when assessing and selecting a thematic ETF, you can consider them in relation to their style factor orientation. So not necessarily in relation to the narrative behind the thematic in terms of expectation of industry growth and so on and so forth. So for example, you can consider earnings per share growth performance for a thematic portfolio in combination with a thematic portfolio's return on equity performance, indicating capital efficiency. In doing this allows you to assess the thematic as to whether or not it has a style factor orientation toward quality. So thematics like cybersecurity, artificial intelligence, and semiconductors, and the semiconductor equity universe I have pictured there for you. Each of those thematic domains historically have rated well in their earnings per share growth performance and their return on equity performance, so indicating quality growth opportunities. And many ETF providers, from Betashares to GlobalX to iShares, are able to provide those insights onto thematic portfolios. On slide 6, our final best idea for constructing portfolios in an alternative manner is using liquid diversifying ETFs such as gold. The idea is that you're able to incorporate alternative asset performance properties into a portfolio without introducing illiquidity into a portfolio. And at GlobalX, we've run a gold ETF for over 20 years. And over that 20-year period, gold has had negative correlations to broad equity universes like the MSCI World, and in fact, has been more negatively correlated to domestic equity universes such as the ASX 200. So pairing gold with equities as a couplet strategy can be a good diversification approach. Slide 7. I wanted to illustrate the risk-off characteristics of gold during market sell-offs. And again, this is in relation to the non-correlation, negative correlation story, especially when it's needed most, when your equity bucket is going down, drawing down. Something that you can rely on is gold. So over the last 19 years, during the worst quarterly drawdowns of the MSCI World, gold, as represented by the blue bars, has positively performed in all cases except one. So showing again the intensity of its negative correlation with risk assets when it is needed most. And gold this year in 2025 is up circa 20%, while equities in terms of the MSCI World is down around 5%. So gold has been working as an equity diversifier this year as well. And that's that. Thank you so much.
Thank you so much, Chad, for that. And I've got our last speaker sort of before we go into the panel session, and just introduce Michael from BlackRock to take us through the last session before we get straight into it.
Thank you very much. Love hearing the thematics. We're fans of diversifying the various betas in our portfolios to build a great, robust SAA. And I don't need to tell you guys, you know, we're in volatile markets, uncertain times, tariffs on, tariffs off, supply chain disruption, global alignments are changing, and it's a change in the world order. So if we go to the next slide, I think it's important that we stop and we think about what's coming. So we don't believe that what we've done in the past is going to get the same result going forward. This is using our forward-looking capital market assumptions built by BlackRock Investment Institute. Philip Hildebrand, former head of Swiss Central Bank, and Jean Bavon, the deputy head of Canadian Central Bank, they run it. Capital market assumptions, return risk correlations by asset classes. And if we look out the next 5 or 10 years versus where we've been the last 5 or 10 years, we think that if you look at the yellow bar on the left versus the red bar, expected returns are going to be down on a 70-30 or a 60-40 portfolio, and volatility is going to be slightly up. So I think we're in a different regime, a higher volatility regime, and one where earnings are a bit stretched. Valuations are high in equities. We've got tariff-driven inflation and slowing economies. So I think our capital market assumptions are saying things are going to be more subdued in a forward-looking sense than back. We go to the next slide. The theme for today, thematics. We've heard a couple things about thematics. I'm going to talk about alternatives. And if we look at alternatives, people looking at them for ballast in their portfolio, for balancing things out. If we think about the correlations between stocks and bonds, broadly over 2000s, except for the last couple of years, stocks and bonds have been negatively correlated. And that negative correlation has brought good ballast to portfolios. But if you go back to the 70s, 80s, and the 90s, there's positive correlation between stocks and bonds. One of the main reasons, inflation. Central banks were trying to get inflation up recently, but back then they were fighting inflation like central banks are now, and a positive inflation shock hurts stocks and bonds at the same time. So most alternatives, if we look at the orange box on the left, most of them lack liquidity. Private equity, private credit, infrastructure, real estate, most of them have multi-year lockups. We're starting to get some evergreen vehicles that have periodic openings so you can get part of your money out. But if you look over on the right, hedge funds can provide uncorrelated returns with daily or monthly liquidity, lower volatility than equity markets, and good ballast for the portfolio. So we're big fans of market neutral, multi-strategy hedge funds. If we go to the next chart, if we plot our capital market assumptions against two different variables. On the left, we've got expected returns versus volatility. On the right, expected returns versus liquidity. On the left, you can see hedge funds, reasonably high returns with quite low risk relative to the other alternatives. And for equities, private credit, they've got high total returns, but they come with meaningfully higher risk associated with them. It's the thing over on the right, and prior speakers mentioned it. If we're thinking about the need, if you've got a client who can lock things up for 5, 7, 10 years, that's great. But if your client needs liquidity, it's an issue. That's where, like hedge funds, high returns, lower risk, and high liquidity. The next chart, and let me be clear, this is not a recommendation. I told our compliance team I would say that. It's an illustration. So taking a 70-30 portfolio, you could do the same thing with the 60-40. And what we've done is we've looked at what's happened over the last 3 years if we had blended in a market neutral, multi-strategy hedge fund. And so that strategy has a volatility of about 3.5. And so we've taken it out of the defensive part of the portfolio, so 70-30, 70-15-15. And if we look at that, we're using something called the BlackRock Global Liquid Alternatives Fund. It's daily liquid. It has 7 hedge funds across equities, both quant and fundamental, fixed income, global macro. It's market neutral. By that, I mean it has a beta of less than 0.1 to stocks and bonds. It's daily liquid, Lonsec recommended. So it's the strategy I picked to make this illustration. So if you can see at the table on the bottom, returns go from 10.1 to 11.6. So meaningfully uplift in the total return. That's because the hedge fund has delivered higher returns than fixed income. It also reduces the risk because it's uncorrelated. And it drives the Sharpe ratio up meaningfully. So that's on average over that period of time. But what about in bad markets? If we go to the next slide, this slide is saying, what if we took the worst 5 months of the past 3 years and look at the two portfolios? The yellow is a 70-30, the green is a 70-15-15. And we compare it to the worst 5 months in MSCI World Equities, the worst 5 months of the global ag. And what do we see? We see then all 10 markets, all 10 months, I should say, the 70-15-15 portfolio does better. Why? It's market neutral, it has diversified alpha sources, and the 3 to 3.5 risk. If we go to the final slide, it just shows that if you choose your hedge funds well, and if they're market neutral, highly diversified, a multi-strat, and you choose something that's daily liquid, you can push out the efficient frontier, so you can get a higher level of return for the same risk, or lower risk for the same level of return. So we're big fans of, in addition to the thematics that are prior to the speakers spoke about, we're also fans of liquid market neutral hedge funds. And with that, let me hand back to Dan.
Thank you so much, Michael. And I think what we'll do is start and open up the panel session. I think it was quite topical, and just open up, I guess, to everyone now on the panel. So there's been quite a lot of discussion about the importance of drawing out investors' attitudes to values, issues around building, I guess, responsible ESG, also focusing on, their attitudes and drawing out, opportunities in the new economy. Should we leave it up to managers to simply pick or choose these companies, or how should they be approaching it from a portfolio sort of perspective, and how you've been seeing it approached, in terms of just a bit of more of a discussion in terms of focusing how the attitudes of investing and what should be used around, should it be specific or choosing companies, or leaving it up to managers within, let's say, thematics, or choosing some of the alternative type managers?
Yeah, I'm happy to answer that one, Daniel. I think just starting off with responsible and ESG investments, what that has really allowed investors is to give them access to things they don't want, things that companies are not necessarily doing the right things. When you think about new economy thematics, you can think of these investments as, investors that want particular aspects of the new economy within their portfolio. So like clean energy, AI, etc. These are necessarily good things as opposed to bad things that they don't want within their portfolios. As to your question to whether, we should leave it up to managers to choose companies, I think if we flip the question, it's quite difficult for an individual investor to select stocks that are exposed to a particular thematic. And if you are doing that, again, you are probably exposing yourself to idiosyncratic risk. It's extremely difficult to pick the winner within a particular theme. And so by choosing something like a thematic ETF, whether that's Asia technology or cybersecurity, you can get a basket of these companies that the manager, like Betashares, has done extensive research with the index provider. You can get low-cost access to structural growth drivers within that particular area. So, for example, we launched a cybersecurity ETF back in 2016, which is Hack. I'm sure many people know about that one. It's been a really popular fund, over $1 billion in assets under management. So there are definitely some fads out there, but there are also very structural themes out there like cybersecurity, which have done pretty well. So I think overall, what thematic ETFs have done is that they provide investors access to a broad gamut of things that they want to express interest in. So again, they can invest in certain areas of the economy they like. And then, with responsible and ESG investments, they can invest in things or in companies that are doing the right things.
Michael, Chad, viewpoints, or any additional sort of viewpoints around that topic? I guess looking at it from a...
Yeah, I'd say from our perspective, whether it's a large institution or a wealth firm, we tend to be led by the client. What is it the client wants? And then work with them to match up. Is it an ETF? Is it a thematic ETF? Or is it something that they want actively managed within the portfolio? So I agree with what Hugh had to say, but I don't, from our perspective, we don't really want to lead the client. We want to really listen and say, what is it? And I think the financial advisor has a huge role to play in the wealth space to really get to know the client. What are the values that they want to see in their portfolio? And then we can talk to the advisor and say, okay, here's something that we can do to help you meet your client's need.
Perfect.
I would say the same thing, actually, echo a lot of that. That thematics can be an expression of preference. It should be client-led for sure. And the way that I have thought about this for many years now is that clients are already doing selection to begin with. They're doing active manager selection, passive selection, and so on and so forth. And if you open up the scope a bit to do thematic selection, and you really defined your process there, I think it is helpful. The other positive benefit of using thematics is that you don't have any, let's refer to it as thematic drift. So if you're going to go into a semiconductor value chain oriented ETF, you know that that's that. In the manager, from an active perspective, they might change course and so on and so forth. We think that particularly for risk profiles that are high growth and growth accumulator, it may make sense to have a little bit more aggression in how you approach the equity side. And thematics are one way to do that, but doing it sensibly. And also, as mentioned earlier, to couple the aggressive equity posture with some diversifiers. And we raised gold as one example. There are many that you can do that with. But I think there are certain benefits to using thematics and having that very focused exposure. And maybe perhaps you can also, within your process around thematic investing, is have, the contours of your rebalancing schedule, the weightings around it, and so on and so forth, so that you're doing it within sensible boundaries.
That makes sense. I think from our point of view, it's looking at it from a perspective, okay, well, if you're doing it on your own, or an advisor is doing it on their own, it's a lot more difficult, and having the use of professional teams, and also obviously underlying investments they've chosen is probably the key around that as well, in terms of aligning to strategic asset allocations and the like. But I guess moving on from that, and specifically around this, and sort of bringing it back to that whole 60-40 portfolio, and starting from the traditional 60-40 portfolio, should we model the inclusion of these types of investments within that? I think from a portfolio construction perspective, I've always seen it as they are satellite sort of options to a core, let's say, solution. And obviously, if you've got alternatives as well as part of that, and looking at alternatives is its own asset class, and obviously it can be modeled a bit differently. How do you sort of, continuing it, or look at from that traditional 60-40, and how should they be included?
We always start with the strategic asset allocation. So I think that's the kind of the core building block. 60-40, 70-30. We're always kind of anchoring on 70-30, but if we think about the 60-40, it's same sort of thing. Global equities, global bonds, local bonds, and then the other thematics, other diversifiers in the portfolio. We've mentioned gold. I love what Chad and you had to say about gold. We've got it in our portfolio. So it's a good diversifier. Listed infrastructure, inflation-linked bonds, short maturity credit, things that are adding to the strategic asset allocation of a portfolio. And then if you've got a client that's got a long horizon and can handle lockups, then some of the illiquid stuff. And then we think about, after we got the SAA, what is the active risk budget of the client? And, spend most of my time focused on big institutions, but what are they looking for? And then how much alpha can we be adding into the portfolio as a second step? But that SAA and thinking about these thematics is, how do they further diversify? How do they bring the risk down in the portfolio while still giving some decent upside return? That's how we start the process.
Yeah, just I mean, we think about, when we're adding a thematic or alternative exposure to your, traditional core, there's probably a few different angles. Like we got to consider, again, similar things, what your risk budget is, your fee budget, and then when it comes to your private market investments, what does your liquidity profile look like? I think investors, need to come back to what their investment strategy is. Again, whether that's going to define what your SAA is, or if you're a, investor who follows a goals-based investing approach, you might have a certain objective that you need to meet in 5 years' time to meet college tuition. That requires liquidity by a certain date and of a certain amount. So when you are allocating, to say an illiquid or private markets investment, that capital has to be, generally held for a much longer time frame. So these three factors I think are quite important. Again, thematic alternative ETFs are generally much more expensive than low cost broad market cap beta exposures. And that can eat into your fee budget as well. So, some clients might be a bit more susceptible to how much they're paying in terms of their investment exposures. So again, just modeling, I think three key things, what does your risk budget look like, your fee budget, and your liquidity profile is extremely important when, adding something like thematic and alternative ETFs to a 60/40 portfolio.
Sorry.
I think that's right. And I think that having thematics between it depends on the risk profile again, but if it's higher growth, higher risk profiles, you can amplify the weightings a little bit more. But having some aperture for thematics can be unconstrained in respective geography, unconstrained in respective sector, unconstrained in respective company size, and so on and so forth. So we've been talking about diversifiers. This is another way to add a further color and texture to the equity bucket. And as a matter of fact, most advisors that we speak to are working hand in hand with asset consultants to begin with. So they can certainly lean on asset consultants to attempt to build out a framework around thematics. They can also lean on iShares, Betashares, VanEck as well, in terms of having those insights into the thematic portfolio, using tools like Morningstar Direct to really get a sense for how it affects things. We've had this conversation again about adding diversifiers. And, bonds, for example, this year have performed okay, not up to expectation. So that, it's good to diversify your diversifiers, a little bit of gold, a little bit of bonds, and similarly with equities. It's good to have a little bit of point of difference away from your plain vanilla market cap weighted portfolios. And you can certainly do that on a theme basis. And I don't necessarily think that you have to have active managers make those selection choices. Maybe in certain instances, yes. But yes, I think a good framework can help you in investing in thematics for sure.
And I think you raise a great point. And I think from an advisor's perspective and how we've sort of the experiences we've had with investment committees and certain advisors has been, I think it's very important to set sort of why you're using such a thematic. How is it going to work in the portfolio? What's the process for keeping it and what's the process for not? So then that way you're constantly reviewing how they're working in portfolios, and obviously how you apply those. Now, I guess we've seen a lot in markets, quite a bit of volatility as of late in markets. There doesn't seem to be any signs of it abating. I just wanted to sort of get what everyone's views are on how do these investments do they exacerbate or do they dampen the volatility? And I think it's a bit of a topical one, but something to sort of see from everyone's sort of perspectives, how that approach is, and given that the next few years might be a bit of a bumpy ride, how that sort of works.
I think the easiest one to talk about is a market neutral hedge fund. The strategy's been delivered positive returns all 4 months so far this year. Is definitely dampened volatility. And I think the aggressive market neutrality of each of the underlying 7 components that are in that multi-strat fund really drives that. So it doesn't have directionality within it. it is at that low end of risk. So it's like 3.5 risk. So, people that want to be in a multi-strat hedge fund that's going to be equity-like, that's not what I was talking about. This is a low vol, uncorrelated strategy that definitely has dampened volatility while still delivering excellent returns.
Just from our perspective, I think it really depends, Daniel. From a thematics point of view, Chad showed that S curve. We see that thematics that are a bit earlier in that curve, a bit more fad-like hydrogen, can exhibit a bit more volatility, but you definitely do have very strong investment themes like cybersecurity, which actually has done pretty well during this environment. So if you look at a cybersecurity ETF like ours, it's actually, returned, pretty, it's held up this year despite the ongoing years of tariffs and what the outlook for the US economy is. So I think that, you really have to assess the investment merits of each thematic individually. I don't think it's correct to lump everything into the same bucket. They will exhibit different and varying levels of volatility depending on where the spending is occurring. With cybersecurity, there's 260 billion US dollars that is expected to occur this year. But if you compare that to something like hydrogen or cannabis, that's a completely different story. So I think it really depends, again, on the individual investment merits. And I think we'll talk about that a bit later on.
I would echo that as well. Certainly thematics that are lower on the adoption curve in terms of beginning stages, commercialization beginning stages, there's more volatility present. But as you ride up the S curve, you can have what's referred to as more defensive growth thematics. Year to date, so far, out of the thematics we track, one that's done very well in performance is defense technology. So if you were able to tune a portfolio into that theme this year, it would have done well. On the liquid alternative side, gold has certainly performed incredibly well as a diversifier in the context of generalized risk across event risk, geopolitics, tariffs, but even in terms of where to from here for the economy with respect to inflation, growth rates, and so on and so forth. As mentioned, we've had a gold fund for 20 years. And I've had this conversation with many in the audience and on this panel, in fact, about gold. And so far, so good. There's a certain framework that we have in terms of green light, red light, in terms of the price drivers for gold. And I can certainly see instances where maybe gold's price action comes off a bit, in as much as maybe there's a dissipation of that event risk with respect to tariffs most immediately and other things. But the efficiency of return on a gold exposure in combination with equities is certainly there. So you have less drawdown if you add upwards of 5% to a stock standard portfolio, bond and equity portfolio. If you add gold to, it improves the Sharpe ratio as well in terms of basically less risk per unit of return. So it stacks up very well. The other thing, just quickly to say, this conversation is not confined specifically to thematics. You would have the same conversation with respect to active funds as well, for sure. And seeing whether or not, you might have an active manager that's aggressive growth. And I'm sure, the portfolio might have heightened volatility as well.
No, that's very fair. And I think to just sort of add to that also, even when you're looking at, let's say, less liquid type alternatives, you have private equity, private debt, going along those lines, I think it's very important, even for those types of investments, and get from a portfolio construction perspective, just to sort of reiterate what we've sort of, and echo what we've sort of heard from advisors, is I always like to say, when you're looking at these investments, it looks like they're very, they are dampening volatility. It's a straight line, A's here, B's there, and it's just a straight line up. The viewpoint I've always said, are we happy to be lied to? And the answer is, do these investments have volatility? Yes, they do. how you're mapping that, you should be mapping that in your portfolio construction piece. And there is volatility, whether it be in public markets or private markets. There is that underhanded volatility. Now, depending on when that illiquidity is marked, that's where that obviously that straight line is there. But it's just keeping that, at the back of your mind as well. Now, when we're looking at this,
Daniel, may I quickly
Yeah.
add something to that? Because it's very pertinent. I had a conversation recently with a client, and their risk team right now was a little bit concerned about the illiquid part of the portfolio because it's not marked to market. And while it's the case that maybe those exposures don't have the same mark-to-market volatility as listed securities do, they were just a little bit concerned because they felt as though perhaps they didn't have their finger on the degree to which the unlisted is the risk level because it doesn't have the mark-to-market volatility. So it is good to have alternatives that perhaps are marked to market. It's something of a double-edged sword that yes, you're going to have a higher expression of volatility, but at least you have a reading and a measurement of it. Whereas with the unlisted exposures, it might not be so straightforward and well understood.
And that's fair. And I think for any advisors looking at this, it's how much work and has been put into understanding how it's been put together if you don't have that transparency. And I think that's probably the key around that. Obviously, we are seeing a lot of thematics offered by issuers. I think that the cheeky question, are these genuine investment opportunities or just fads? But maybe that's the first part, but maybe sort of curtailing it onwards is, what are some of the red flags in assessing new thematics or private assets? And how do you differentiate? I think that's sort of a two-sided sort of question that might be something good to discuss in this panel.
I think it's a great question. Thinking about, everything that we're doing in investing is forward-looking, right? And we're going to use the data that we can to calibrate from history and so forth. But it's all about forward-looking, and it's about sitting down and thinking about which of these thematics are going to be around, like cybersecurity. That's not going away anytime soon. Gold's not going away anytime soon. These are things that are, cybersecurity is going to get more and more important as AI becomes more prevalent and so forth. So we think it's like thinking about what is the future going to hold, and is this a blip, or is it going to be something that's going to be real? There's going to be billions that are going to flow into it, and therefore it's something to be thinking about. The flip side, in that prior conversation around illiquid alternatives, I think it's really important that we're stopping and thinking about who are we investing with, because on the illiquid side, it's so much about the active management team. It's about the asset selection process and ensuring that you're going with somebody that has a proven track record, a team that's got good governance, good transparency, and the ability to work with advisors so they can inform their end clients around what's going on. So, like, I'm kind of talking quite a bit about market neutral hedge funds. Been doing it for well over 20 years in Australia. So it's something that we know, we've lived, we're doing, and I can talk to clients about every event that's happened and how it's impacted hedge funds in the last 25 years.
Yeah, when you're thinking about the viability of a thematic product and its longevity, I think, a couple of things we look out for are things like flows, like are there flows coming into this product? Where is the future trajectory of this investment merit and theme? Things like performance, how has the thematic fund performed, and also just looking at the constituents. I think the beauty of ETFs is that it provides that transparency and look through into the underlying holdings. So if we look into cybersecurity and our hack ETF, you can see the top 10 holdings. These are very large incumbent players within the cybersecurity market. They're companies like CrowdStrike, Palo Alto. Everyone knows these names. They're large cap US listed companies. If you think about more of fad thematic and you look at the underlying constituents there, you can see there's probably a big difference in terms of the size of the company, and they probably don't have as much inflows coming into it. So just for an investor, you can use those kind of metrics just to assess at a high level what this thematic looks like, but also just having a look online and seeing if the industry is talking about where spending is occurring. Again, global defense is another strong thematic that is occurring because the German government is, spending billions and billions of dollars more on defense spending. So obviously that's going to be a major beneficiary for global defense ETFs. So yeah, that's sort of like how you would position whether a thematic ETF would be a genuine investment for the future.
I would echo everything said so far. Is looking at the size of the addressable market currently, expectations around the growth of it. If you think in relation to hydrogen, almost immediately everyone on the call will know that it's not widely used and so on and so forth. So very limited at the moment, but maybe perhaps if there's propellants in terms of technological change that make it more effective to be used broadly within the wider economy. Maybe it has an S-curve, maybe it doesn't. I remember the meta universe idea that hasn't actually crystallized into a mature theme as yet, but maybe in due course. So I do think for illustrated purposes that adoption curve runway helps a little bit to just segregate those themes that are a bit more mature from those themes that are less mature, as one way to kind of parse through the thematic universe.
And I think this was touched before, and we've been going through some of these questions, but given that many of these investments, such as, let's say, within some of the thematics, let's say data centers, solar farms, have relatively short histories, and just to understand it from an advisor's perspective, how do, I guess, PMs or those underlying funds accurately assess the risk? And I think that's an important one, giving a few examples there, but maybe overall as a general sort of approach around that. I might want to Hugh started off and go from there.
Yeah, we kind of briefly touched upon it in the previous question. I think thinking about the size of the companies can often be helpful because that will often give an indication as to how long they've been in the market, what the sort of supply chain looks like, whether customers are buying that product. I think at the end of the day, it has to come back to that addressable market if people are going to continue spending on it. And so I think it is, safe to say that it is very difficult to assess the viability and risk of very nascent funds and industries. You do need, a little bit of a track record to play out generally to assess the viability of that sort of domain. I think that at least from Betashares in our product development committee and group, we are very client-led in coming out to market with new ideas and themes. If there is strong demand for something like cloud computing, and we do believe in the prospects of that industry and thematic, then we'll definitely do a bit of research and work with an index provider that can provide a true to label exposure. And so, in fact, we do have a cloud computing ETF, but for example, we don't have a hydrogen thematic ETF. So we really do a lot of work from a product development standpoint, listening to clients, advisors, and then once that is underway and we are comfortable with that theme, then we'll work with our index provider to provide that exposure.
I can add a little bit to that is, from our side to ensure that we're tuning into the thematic as accurately as possible, because you can get thematic selection correct, but you get the thematic portfolio wrong in terms of the underlying stock selection and the way in which you construct it. So I think one way that you can go about, ETF providers can go about composing thematic portfolios is looking at the degree to which a certain stock is revenue pure in relation to a theme. So you can have revenue purity considerations. And of course, you want to capture companies that are more immediately connected to the commercialization and unfolding and rollout of a certain, say, if you're technology, artificial intelligence. So there's certain things that on our side, ETF providers do. But some of these themes actually have begun to have track records. So semiconductors have a fairly extensive track record of performance that you can dive into and look at. And of course, that thematic domain itself is evolving over time, but you can certainly get a reading in relation to some of these themes of their volatility, of their drawdown behavior on a historical basis, and things like that.
And just maybe thinking about time as well, but maybe something that's really, really important in terms of a question that does get asked by advisors. But looking ahead, let's say, from the expert panels, 5 to 10 years, what are some of the areas of the new economy that I guess, are currently underappreciated right now, I think, that investors might want to sort of dig into a little bit more at a high level?
I think one thing is the downstream effects that AI will have on the broader economy. I think what we've seen over recent years that's really fueled the bull run in the S&P 500 is the AI hardware narrative. So really driven by the CapEx spending that the Magnificent Seven are doing. But I think what investors might be underappreciating are, things like software providers and cloud computing companies that might be able to benefit from the productivity gains that cheaper, more efficient AI models can bring to market. So again, software companies that can leverage the potential of AI is an area that I think is not as well known. And I think what you'll see in the next 5 to 10 years, that second layer will go into another layer, into the real economy. So I think you'll start to see the benefits of AI play into manufacturing and also factories as well. So even in China, what you're seeing already is an influx of robots that act like humans within EV factories. So they're already building cars with humanoids. So, the sort of trajectory for that space is huge. Obviously, we're seeing that right now in China, but I think what you'll see over time as these technologies advance is that you'll see an increasing adoption across countries as everyone begins to adopt AI. So I think that's a couple areas that investors might be underappreciating.
Thanks, Hugh. Michael, did you want have anything around that one as a quick one, and Chad, eventually?
I was going to say that it sounds very much like a thematic question, but I would say hedge funds are greatly underappreciated, particularly if you can get a daily liquid, low risk, low cost version.
Chad, any viewpoints on go forward?
Maybe some of these themes, of course, you can think of them as trading tools as well, in terms of window of opportunity. Others less so and more buy and hold. But what comes to my mind at the moment is defense technology. So we're sitting here in a context where you can very palpably feel geopolitical tension, and you can see that, of course, the U.S. is pushing countries to up the ante of military expenditure as a portion of their GDP, from Europe onward, Japan, et cetera, et cetera. And a lot of these countries historically had sat under a security umbrella that the United States provided, but as a way to burden share, it looks like they're going to have to, other countries, go down a path of building out their military base a bit more. So for investors who are interested in things like that, perhaps, although maybe there's ESG considerations to think about as well, there's some sensitivity for sure. But again, just in in the current environment and the dynamics that are occurring between countries, it looks like military expenditure is here to stay. And that's going to be a actually, in fact, it's not so tradable. It depends on the valuation, though. Maybe it's priced in already. But that's going to be a multi-year process. But of course, you have to keep in mind the valuations to see if they're kind of already priced in. That's a valid concern. So maybe defense technology.
Thank you. And I think from our side,
The,
it's volatility control and liquid alternatives. But I might sort of hand it over to Toby.
Yeah, well, I was just going to say the interesting point for me is the intersection between Hugh's observation about AI and Chad's about defense, because those of you who, like me, read 4 or 5 newspapers a day will know that the Ukrainians shot down 2 Soviet jets taking off from a Crimean airport. They did it with a seaborne drone and missiles, and we're clearly in a world where the capacity to integrate AI into every aspect of even those least attractive parts of our life is now central. So look, to Michael, to Chad, to Hugh, and especially to you, Daniel, for your work over the last 3 days. Thanks very much. To those of you who've attended today, I hope you found it worthwhile and interesting, and over the whole week as we've thought about the issues of developing portfolios where clients have other goals than the simple 60-40 or BlackRock's 70-30. So thank you very much. Look, please, we look forward to you joining with us in July in person in our Advice in Action. Advice, as we all know, is right there. AI in the headlights for many advisors. Certainly for us at IMAP, it's something we're thinking pretty hard about and utilizing in an increasing number of aspects of what we do. And for those of you who'd like to participate in the awards, I'd encourage you to register now and to take part. So thank you very much for your time, everybody, and we'll look forward to you joining us in future IMAP events. Thank you very much.
Thank you.
Thank you.
Thanks, Toby.